Hello there, my friends. Chris Marcus here with you on Friday, August 11th. And today we have an exciting video about Alan Greenspan. Yes, even the Maestro is issuing warnings that the stock market is a bubble. What more signs do you need? Hey, you're finally not hearing it just from me anymore because we have an article about a week old. Looks like it's from August 4th here, where former Federal Reserve Chairman Alan Greenspan issued a bold warning last Friday that the bond market is on the cusp of a collapse that will also threaten stock prices. Okay, correction, he said there are bond and stock bubbles, of which I couldn't agree more. Why he didn't do much more about that when he was actually in office and had a chance, yet followed the I guess maybe he set a new script. I mean, you had Volcker who raised interest rates to 18% before that. Um, now Bernanke and Yellin have piled on to what Greenspan has done since then. I'd have to think about that if there was someone else who really did things, or if Greenspan was really the one who started a lot of this. In either case, it's always ironic to me just that used to be going around with Ayn Rand talking about how great the gold standard was, then printed a lot of cash, led to two bubbles under his watch. Anyway, enough of my words here. Let's keep going with the Maestro himself, where he says the current level of interest rates is abnormally low, and there's only one direction in which they can go, and when they start, they will be rather rapid. Low interest rate environment has been a product of current monetary policy, which he instituted from 87 to 2006. And doesn't sound like he's a fan of what the Fed's doing now. Says he did not criticize the policy of the Fed, but warned that low rate environment can't last forever. Agreed. And will have severe consequences once it ends. Certainly agreed. A few more quotes here from Alan. I have no time frame on the forecast. I have a chart which goes back to the 1800s, and I can tell you that this particular period sticks out. But you have no way of knowing in advance when it will actually trigger. So again, what can I say? I agree with everything the man says, except for what he did between 1987 and 2006. And yeah, this should stand out because I don't know of any other period in history where we've had negative interest rates and central banks buying stocks, any bond that nobody else wants to buy, basically saying we don't want the prices of these to go down. We're going to print money to prop it up artificially. Shockingly, yes, that is how your Wall Street system works. Unshockingly, it's not very sustainable, which is why we have bubbles every once in a while. Here's a good quote from the Maestro about timing bubbles, which I've learned thoroughly in the past couple of years. It looks stronger just before it isn't stronger, and anyone who thinks they can forecast when a bubble will break is in for a disastrous experience. Very much agreed there. Again, another reason what I like so much about silver. I wish I could tell you the day the manipulation is going to get overrun. I wish I could tell myself, tell my brokerage account. All would be good things, but unfortunately, I don't know that. And what we can do around that is structure our decisions, our trades, activities in a way that the timing can go in your favor rather than against you. So if you're buying silver or gold or any asset for the long term that you think at some point all these things I see with the debt loads and the printing money is going to have to be resolved. I don't know if it'll be tomorrow or next month or next year, or if it's pushed out a couple of years. As I've said many times here before, I think we're pretty close. Continue to think the Bitcoin prices are indicating that things are getting somewhere, wherever that somewhere may be. Yet I also have to factor in that these things can go on longer than I would expect. So I think Greenspan's very right there when he talks about being careful of trying to time the bubble. Not an easy thing to do. If you, by all means, have figured out when the bubble is going to end, please, please leave a comment below, because I'd love to know. But at least that's a big part of trading. Or again, if you look at the poker analogy where you're dealing with imperfect information, so you may not know things 100%, but you work all these probabilities into your favor, structure your bankroll so that when a good trade comes along, you can take it without risk of that being the end of your game or the end of your retirement savings or your portfolio. I think you get the point. Then you can use these things to your advantage. Again, going to the short-term Wall Street trading mentality. Again, I say this even as someone who's trading equity options, which by nature is short-term. Part of it is accepting. It's like you hear the baseball players, you take the pitch where it is, you can't, if it's not a pitch that you can hit a home run on, then you don't try and force things that aren't there. Similar with the markets. And there you go. Now you got a poker and a baseball metaphor all in the same video. And last comment from Mr. Greenspan here. You can never be quite sure when irrational exuberance arises. And he was talking about his famous Irrational Exuberance speech. I was doing it as part of a much broader speech, talking about the analysis of markets and the like. And I wasn't trying to focus on the short term. But the press just loved that term. Press does love terms like that, and certainly the irrational exuberance over 8 years of 0% interest rates. All right, fine. The last year we've had 1%. Excuse me if I'm not blown away by that massive hike and normalization, all the while with another $4 trillion sitting on the balance sheet. Translation, if I'm getting too technical for anyone, they've printed an insane amount of money that we hear them always talk about unprinting, yet the reason that they don't unprint it is for the same reason they wanted interest rates lower, because it gives a lot more cash, especially to the banks, makes things look better, yet, simple example, let's say you could afford 4% interest on property you want to buy. So if market interest rates are at 5%, that means it's more than you can afford. You don't take out the loan. Then the Fed comes along, lowers rates to 3%, and all of a sudden, wow, this is great. It's getting savings. It's even less than the 4% break even. So someone takes out the loan, which is great because interest rates are low. But what happens if Fed or insert central bank of your country raises rates 5% to 6% to 7%, all of a sudden all these loans go bad. Again, don't take my opinion for it. Look at what happened when Greenspan started raising rates following, I guess it began in 2004. And predictably, the bubble collapsed. That was the primary factor of, there were a lot of things going on, but why did it collapse when it did? Why did it inflate when it did? Look at Greenspan's interest rate policy. It's great that he's telling you what I agree with everything he's saying now. Unfortunate he didn't follow that path when he was actually in office, but in either case, it doesn't have to be rocket science. This stuff can be simplified and make sense, which is what we're here to do. So I hope you're finding this one helpful. With that said, it is now weekend time. Stop thinking about finance. Go make a trade or two. But then, certainly as I've gotten a little older and gotten away from the 20s, working on a trading floor, thinking it's great to be angry and miserable and yell at people if the trade doesn't go your way. Growing up a little bit in life, I see that, yes, there's value in understanding these things. Also value in giving yourselves a break. So with that said, hit the subscribe button. Have a great weekend, and we will see you again on Monday. Thanks.